Picture this. Wall Street is a circus. Traders are yelling, screens are flashing red, everyone looks like they just lost their lunch money. And you? You're chilling with your iced latte because you've got ETFs. But here's the kicker. ETFs aren't the simple set it and forget it miracle you've been sold. Behind the curtain, there's a machine so sneaky it makes magicians jealous. And wait, what happens next will blow your mind. Meet Smith. He's your classic passive investor. Loves index funds, hates drama, and brags at parties that he owns the market. One day, Smith notices his ETF tracks the SP 500 almost perfectly. Even when markets are going nuts, he thinks, wow, ETFs are flawless. Most people panic when stocks swing like a roller coaster, but not you. You're part of the smart minority who wants to know what's really happening behind the scenes. And once you see how ETFs actually work, you'll never look at your portfolio the same way again. Here's the secret Wall Street doesn't put in the brochure. ETFs don't magically contain infinite shares. They're powered by something called creation and redemption, run by special players called authorized participants, or APs. Think of APs like backstage crew at a concert. You see the singer, the lights, the crowd, but behind the curtain, someone's swapping guitars, fixing cables, and making sure the show doesn't collapse. That's what APs do for ETFs. When demand rises, APs literally build a basket of the underlying stocks, like assembling a grocery order. They hand that basket to the ETF issuer, and in exchange, they get shiny new ETF shares. That's called creation. So when you buy an ETF, you're not just buying from thin air. You're buying shares that were created by someone swapping stocks behind the curtain. And when demand falls, APs do the reverse. They return ETF shares to the issuer and get the underlying stocks back. That's redemption. This constant swap is the secret sauce that keeps ETF prices close to their net asset value. It's why ETFs don't usually trade at crazy premiums or discounts, unlike some mutual funds that can feel like buying concert tickets from a shady scalper. And this is where things get really interesting. But here's the part Wall Street doesn't shout about. Some ETFs can be created using cash instead of the full basket of stocks. Sounds convenient, right? Except it can introduce tracking errors, hidden trading costs, and even tax surprises. Translation: your perfectly passive ETF might be borrowing a little chaos from the market. ETFs are famous for low fees. You see 0.03% expense ratios and think, wow, basically free. But here's the catch. Bid-ask spreads. Every time you trade, you pay a tiny hidden toll. Trading costs inside creation redemption. APs don't work for free. Liquidity traps. Niche ETFs like exotic bonds or commodities can have wider spreads, meaning you pay more just to get in or out. It's like going to a restaurant with cheap menu prices, but every time you order, they sneak in a kitchen handling fee. Fast forward to today. Apps like Robinhood and Webull have turned trading into a noisy carnival. Millions of retail investors are buying and selling ETFs like they're Pokemon cards. Meanwhile, APs and market makers are busier than ever, keeping ETF prices glued to reality. But here's the kicker. Not all ETFs are created equal. Big ones like SPY or VOO, smooth as butter. Weird niche ETFs, like one tracking rare metals or frontier markets, more like juggling flaming swords. During stress events, think March 2020, some bond ETFs traded at discounts of 5 to 6%. Investors thought they were safe, but the backstage machine was wobbling. Most people just see the shiny ETF ticker and think, cool, I'm diversified. But you're part of the smart minority who knows there's a whole hidden system underneath. Wall Street loves when you don't ask questions, because the less you know, the easier it is for them to profit off spreads, fees, and complexity. But once you understand creation redemption, you're no longer the clueless tourist. You're the insider who knows how the ride works. Next time you pick an ETF, don't just look at the expense ratio. Check who the APs are, average bid-ask spread, how liquid the underlying assets are. Ask yourself, does this ETF trade like a stock, or like a fragile vase. And if you want more backstage passes into Wall Street's secrets, hit subscribe. Because remember, you versus them, you read the label, they hope you don't. ETFs are like vending machines for markets. Convenient, but sometimes someone else stocked the snacks.